Good morning, everybody. Mike Vacchi, PrincetonTrader.com, here for NTMarkets.com with your Tuesday morning pre-market webcast. Okay, S&P 500 E-mini futures, December contract. I've got the front month chart up here, not the continuation chart, because I want to talk about the middle band and I want to talk about some other areas of potential resistance here. What we saw yesterday was a move down to the lower band. The Bollinger bandwidth is very tight. We're at 1.44. And you know, we talk about this before. Anybody that's followed this webcast for any period of time knows we talk about compression and then expansion. Well, right now we're in a period of compression. And what's happened is the bands were very wide after the lower band ride and the move higher. Okay, the bouncing up, the move lower and the move up blows out the bands. But then what we had here, beginning pretty much on August the 21st, is we've just had essentially flatline activity. And as these numbers drop off of the 20-day simple moving average, what you're seeing is these bands coming in really quickly and becoming extremely tight, because the majority of what they're measuring is this flatline activity here. So there's a couple risks. Don't anticipate the direction of a band ride. Anticipating the direction of a band ride can really get you murdered. And you only need to talk to people that thought back here that this was going to be an upper band ride, or if you go back on the continuation chart, you could always have a discussion with these people right here that thought that this red candle was going to be the start of a lower band ride and then got completely crushed. So don't anticipate direction. Okay, what we've seen on the continuation chart is a bounce off the third standard deviation band. We're back below the lower band. You can see the continuation bands starting to expand. For a number of reasons that I don't have time to get into on this webcast, I prefer using continuation bands versus front month bands. They tend to be more accurate. They tend to be a reflection of price, at least after the first couple of days of the roll, and they tend to be the numbers that that price tends to react to. So the fact that we are below the lower band, which is 74.71 today on the continuation chart, has me at least giving the bears more credit than I would normally give them on the day before an FOMC meeting. Typically, what do we see? We see a walk up into the Fed. So let's go back to the December contract, because if we do walk up, where might we walk up to? Two areas jump out at me. You've got the middle band on the December contract, which is 1986.61. Beyond that, you've got the, I shouldn't say beyond that, I should say below that, you have the weekly pivot, which is 1981.90. So I'm looking at 82, then I'm looking at 86. Those are decent areas for a walk up. What we've seen in the past, though, is we've seen these continuation bands matter. So 1993.33, and this little preview of what I would be looking at into tomorrow, into a number into the Fed. If it's a positive reaction off of the Fed announcement, okay, but we don't game the Fed, but we have options. If it's a positive reaction off of the Fed announcement that bounces up to that area, to the green line there, the 1993 area, or wherever the middle band happens to be at 2 p.m. tomorrow, and fails there, that puts the bears into a decent position to push back to the lower band and potentially expand those bands for a lower band ride down. If the bulls get over the green line, then what we have seen the last couple of days is a head fake. If it's a head fake, then we're going to go back to the upper band. And by default, going back to the upper band will mean a retest of the 2011 highs. Okay, that's all I've got. Follow us on Twitter at Princeton Trader. Come check out the website, PrincetonTrader.com. Come check out the chat room. I will be back tomorrow morning with another webcast. Trade 'em well.